GM 105, Spring 2024, Midterm Number 2 Questions. 1. How do differentiation, cost leadership, and blue ocean strategies support a forward-looking business strategy? Differentiation, cost leadership, and blue ocean strategies serve as cornerstones for a forward-looking business strategy, each offering unique avenues for competitive advantage. Firstly, differentiation involves creating products or services that stand out from competitors, often through unique features, superior quality, or exceptional customer service. By differentiating offerings, a company can command premium prices, foster brand loyalty, and insulate itself from intense price competition in the market. This strategy is particularly effective in industries where customers value distinctiveness and are willing to pay a premium for it. Cost leadership, on the other hand, focuses on achieving operational efficiencies to deliver products or services at lower costs than competitors. By streamlining processes, optimizing resource allocation, and leveraging economies of scale, companies can undercut rivals on price while maintaining acceptable levels of profitability. Cost leadership enables firms to capture market share, attract price-sensitive customers, and withstand price wars initiated by competitors. This strategy is especially advantageous in industries characterized by high price sensitivity and commoditized offerings. Blue ocean strategy entails exploring uncharted market spaces and creating new demand by offering innovative products or services. Unlike traditional competitive strategies that focus on outperforming rivals within existing market boundaries, blue ocean strategy involves making competition irrelevant by uncovering uncontested market space. By innovating and redefining industry boundaries, companies can escape the cutthroat competition of red oceans, existing markets, and achieve sustainable growth in blue oceans, untapped markets. Blue ocean strategy encourages companies to think creatively, challenge industry norms, and unlock new sources of value for customers, thereby driving long-term success and market leadership. 2. How can innovation and entrepreneurship influence a company's business strategy? Innovation and entrepreneurship exert profound influence on a company's business strategy, shaping its direction, competitiveness, and long-term viability. Firstly, innovation drives the development of new products, processes, or business models, allowing companies to meet evolving customer needs, seize market opportunities, and differentiate themselves from competitors. By fostering a culture of creativity and experimentation, companies can continuously improve existing offerings and introduce disruptive innovations that revolutionize industries. Entrepreneurship, on the other hand, promotes a proactive and agile approach to business strategy, encouraging risk-taking, resourcefulness, and adaptation to changing market dynamics. Entrepreneurs within organizations champion new ideas, ventures, and initiatives, driving exploration of new markets, technologies, and revenue streams. Entrepreneurial thinking encourages companies to embrace uncertainty, seize emerging opportunities, and challenge conventional wisdom, thereby staying ahead of the curve in rapidly evolving markets. Together, innovation and entrepreneurship empower companies to navigate industry disruptions, anticipate customer trends, and sustain long-term growth. By integrating innovation and entrepreneurial principles into their business strategies, companies can foster a culture of continuous improvement, agility, and resilience, positioning themselves for success in today's dynamic business landscape. 3. How do vertical integration and diversification impact a company's organizational structure and activity? Vertical integration and diversification have significant implications for a company's organizational structure and activities, influencing how resources are managed, decisions are made, and operations are conducted. Firstly, vertical integration involves expanding control over the supply chain by integrating upstream or downstream activities. This integration can lead to changes in the organizational structure as the company may need to incorporate new departments or functions to oversee the additional stages of production or distribution. For example, a company that vertically integrates backward by acquiring its suppliers may need to establish new procurement or supply chain management departments. Similarly, if the integration is forward, towards the customer, the company may need to establish new sales or distribution channels. Overall, vertical integration reshapes the organizational structure by aligning it with the integrated supply chain, promoting greater coordination and efficiency across different stages of production or distribution. On the other hand, diversification involves expanding into new markets or industries to spread risk and capitalize on growth opportunities. This expansion can lead to changes in the organizational structure, as the company may need to establish new divisions or subsidiaries to manage the diversified portfolio of products or services. Each division or subsidiary may operate semi-autonomously, with its own set of resources, personnel, and management structures. Diversification also influences decision-making processes, as managers may need to consider a broader range of factors and market dynamics when allocating resources or setting strategic priorities. Overall, diversification reshapes the organizational structure by creating a more complex and diversified business portfolio, requiring effective coordination and strategic alignment across different business units. In summary, vertical integration and diversification impact a company's organizational structure and activities by influencing how resources are allocated, decisions are made, and operations are conducted. These strategic initiatives require careful planning and management to ensure that the organizational structure remains adaptable, efficient, and aligned with the company's overall strategic objectives. 4. How are mergers, acquisitions, and strategic alliances used to achieve a company's corporate goals and objectives? Mergers, acquisitions, and strategic alliances serve as strategic tools for companies to achieve their corporate goals and objectives by leveraging synergies, expanding market reach, and enhancing competitiveness. Firstly, mergers involve the consolidation of two or more companies to create a single entity with enhanced scale, market reach, and capabilities. By combining complementary strengths and resources, companies can achieve economies of scale, reduce costs, and enhance operational efficiency. Mergers allow companies to pool their expertise, technologies, and customer bases, enabling them to offer a broader range of products or services to a larger market. Additionally, mergers can facilitate diversification into new markets or industries, reducing risk and enhancing growth prospects. Acquisitions enable companies to rapidly expand market share, access new technologies or talent, and diversify product offerings. By acquiring competitors or complementary businesses, companies can eliminate competition, consolidate market power, and capture synergies. Acquisitions provide companies with immediate access to new customers, distribution channels, or intellectual property, accelerating growth and enhancing competitiveness. However, successful acquisitions require careful due diligence, integration planning, and post-merger integration to realize the intended benefits and avoid potential pitfalls. Strategic alliances involve collaborative partnerships between companies to leverage complementary strengths, share resources, and pursue common objectives. These alliances enable companies to access new markets, technologies, or distribution channels without the need for full ownership or control. Strategic alliances can take various forms, including joint ventures, licensing agreements, or research collaborations, depending on the nature of the partnership and the strategic objectives involved. By pooling resources, knowledge, and capabilities, companies can achieve mutual benefits, mitigate risks, and capitalize on growth opportunities in a rapidly changing business environment. In summary, mergers, acquisitions, and strategic alliances are strategic mechanisms for companies to achieve their corporate goals and objectives by leveraging synergies, expanding market reach, and enhancing competitiveness. These strategic initiatives require careful planning, execution, and management to ensure alignment with the company's overall strategic direction and long-term success. 5. What would motivate a company to pursue a global strategy, and what is necessary to achieve a successful program? Companies are motivated to pursue a global strategy for several reasons, primarily driven by the desire to capitalize on new markets, resources, and economies of scale. Firstly, accessing new markets provides companies with opportunities for growth beyond their domestic boundaries. Emerging markets, in particular, offer significant potential due to their expanding middle class, rising consumer spending, and untapped demand for goods and services. By expanding globally, companies can diversify their revenue streams, reduce dependence on mature markets, and mitigate risks associated with regional economic downturns or fluctuations. Additionally, pursuing a global strategy enables companies to access valuable resources, such as raw materials, labor, and talent that may be scarce or more cost-effective in other regions. Global sourcing allows companies to optimize production costs, improve supply chain efficiency, and enhance competitiveness in the global marketplace. Furthermore, global expansion provides companies with opportunities to leverage economies of scale in production, distribution, and marketing, driving down costs and increasing profitability. To achieve a successful global strategy, companies must address several key factors. Firstly, thorough market research and analysis are essential to identify attractive target markets, understand local customer preferences, and assess competitive dynamics. Companies must adapt their products, services, and marketing strategies to local cultural, economic, and regulatory environments to resonate with diverse customer segments. Effective cross-border coordination and communication are critical to ensure seamless operations and alignment with the company's overall strategic objectives. This involves establishing efficient supply chains, logistics networks, and distribution channels to deliver products or services to global markets effectively. Furthermore, building strong partnerships and alliances with local stakeholders, including suppliers, distributors, and government agencies, can facilitate market entry and navigate regulatory complexities. Investing in talent development and cultural competency is also essential to build a global workforce capable of operating effectively in diverse cultural and business environments. Finally, companies must actively manage risks associated with global expansion, including currency fluctuations, political instability, regulatory compliance, and intellectual property protection. Implementing robust risk management strategies and contingency plans can help mitigate these risks and safeguard the company's investments and operations in global markets. In summary, companies are motivated to pursue a global strategy to capitalize on new markets, resources, and economies of scale. To achieve success, companies must conduct thorough market research, adapt their strategies to local market conditions, build effective cross-border coordination and communication, establish strong partnerships and alliances, invest in talent development, and actively manage risks associated with global expansion.